Welcome back. Continuing our conversation on the markets, we are being joined by Rakesh Vyas from Quest Investment Advisors. Rakesh, good morning. Thank you for joining in. After this brief lull that we saw in the markets over the last couple of days, back towards making that dash towards the record high, do you believe that there are triggers in place to take the markets higher from here, or there are some underlying concerns as well?
Yeah, hi, good morning, and thanks for having me here. No, I think if you look at it, the large part of this rally, which we expect to continue going forward, will probably be led by rebound in the earning growth trajectory that as we see. And I think a lot of the impetus action that's been taken by both the central government as well as the RBI is expected to drive a lot of growth in terms of consumption thereof and also in terms of lending and credit growth. All of that would probably translate into much better earning growth as we move into calendar year 26. And I think as markets are forward looking, the confidence that market gets around normalization of this strong earning growth over next 4 to 6 quarters is what will continue to drive the market higher. And also, given that markets today are in fair range in terms of their average multiples, we can actually expect market returns in line with the earning growth as we see forward. So I'm pretty hopeful that market will probably start to see much more upside from here on.
Rakesh, wanted to talk about one of your top holdings, that's Vishal Mega Mart. Now, just yesterday, a colleague was saying that how Vishal Mega Mart is promoted by, the private equity firm Kedara Capital, and they've been, through the IPO, the offer for sale, and then later, they've been bringing down their holding, and now it looks like Kedara, which is a 54% holding in Vishal Mega Mart, may look to do another block deal and sell an additional, I think, 13-15%. So now their holding would go sub 50%. I mean, how does that change the dynamics, the fundamentals, the lack of control that the PE will have? I mean, would that worry you, this additional supply, and the fact the management control is now below 50% holding?
Great question, Rima. And I think as a market, we need to become slightly more mature in terms of these private equity divestment that will continue to come through. So if you look at most of the new age companies that have got listed, many of them are private equity owned or backed. But over time, one also have to realize that these funds actually have a limited life, and therefore we will continue to see exits thereof. You still have a lot of platform players which are non-promoter backed, but still doing well. For example, we have our largest holding in Eternal for almost 2 years now, where there is actually in terms of stake, there is no large promoter left, right? But that business is still doing very well. It's very well professionally managed. So I think we'll have to come to a point where you have to recognize that some of these large companies that have got listed in the equity markets now will be mostly non-promoter led, professionally run. And I think in that context, the management of Vishal has done exceptionally good job since they have acquired this business. They continue to expand rapidly, even in a tough environment when SSSG growth was difficult to come by over last 4 to 6 quarters. They have been able to do a very good job of delivering double-digit SSSG. So, of course, supply pressure will remain in many of these companies, but one has to look beyond that and look at the fundamentals of business. And I think we still remain very, very constructive on some of those names. Even when, as you highlighted, we could continue to see intermittent supplies coming from private equity or promoters in general.
Okay, so that's about Vishal Mega Mart. You also have holding in Trent Limited, Rakesh. We've seen a big fall in that particular name. There were valuation concerns as well. Growth was slowing down. What makes you positive on this? Do you think that interest that we saw from shareholders in that massive rally could come back?
So I think you are right. The growth slowdown has been for real. And that's been the challenge in the urban consumption space to a large extent. Also, what has accentuated two things, which is much higher store expansion that Trent has done towards the end of last fiscal, and they still needs to become profitable at store level because it takes some time, and therefore it is reflecting in some sort of lower earning growth as well. But post that large expansion, they have actually moderated their growth plans already. So I think margins will probably to improve better from here on. And also, as I was highlighting, we remain fairly bullish on consumer discretionary as a space. And given that a lot of this tax incentives that have come into the hands of consumer will start to reflect into better consumption growth, and Trent probably is the market leader in terms of value fashion, and they should be a reasonably good beneficiary out there, given that they have very strong network of stores and will continue to see growth thereof. I think as the growth rate comes back, the re-rating will follow. So we remain fairly constructive on this name so far. If we see a material slowdown in growth sustainably going forward, I think that's when we will probably take a measured call. But we are fairly convinced that over the next 4 quarters, we will see strong rebounding growth.
Indeed, the street gets used to 35-40% growth and then starts to panic when the growth goes down to 15 to 18%. But Rakesh, very interesting holding in your portfolio is the PSU Bank Bs. You're having PSU Bank ETFs here, so you're betting on the entire space. Now, the stocks have run up considerably, but there is a chatter of the smaller banks being merged into larger ones, the exercise being underway. Do you still believe that even after the run-up, these PSU banks have value in them, considering that they have been beaten down for far too long?
So you are right, Armaz. I think stocks have done very well, but you also have to take into account that PSU banks have been able to withhold their market share to a large extent over last 4 to 5 years. They actually lost a lot of market share on the asset side pre-COVID. But given very strong liquidity that they have and the branch network, they have been able to bounce back very strongly and therefore able to manage market share. And if you look at the valuation metrics that exist today between private and PSU, there is no major difference between the growth rates or the asset quality per se. And therefore, there is always a rationale for some of this valuation gap to narrow unless we see any of the challenges either in terms of asset quality coming in or they lagging in terms of growth. But I don't see that being on horizon for next 4 to 6 quarters. So I think they still remain a reasonable bet. There are specific companies within the space where with the change of management, there could be increased focus on higher growth rates, etc. But I think overall as a space, we remain positive. But you are right. We'll again have to be very cognizant of the fact that there could be a consolidation in the space. And what is the contours of that consolidation will determine our next course of action. But till that point of time, we remain very, very positive.
All right. Thank you so much for joining in and taking us through your holdings and the analysis on markets as well. Time for a short break. We'll get you more on the markets on the other side.